Welcome to the panel session, and today we're going to discuss what does 2021 have in store for advisors and clients. In trying to arrive at that, we're going to examine the structure of the Horizon multi-asset fund range, look at each layer of the process, and then hear from each of the parties involved in the governance and management of the portfolios to try and understand how they work together. We're going to look at what's been going on in what has been and continues to be a momentous and extraordinary year, and we're going to look forward to next year and perhaps beyond. So welcome everybody, and thanks very much for taking part in this discussion. Thomas, if I may come to you first, just thinking about the structure of the portfolios, how are the funds structured and why have you chosen to work with Value and Columbia Threadneedle investments?
Richard, thank you, and let me give you just a high-level overview of how we build the funds and why we've chosen these partners. So we see there are three layers of management in the funds. There's the role of the ACD, which is Embark Investments, overseeing the structure and making sure that over time they do what they say on the tin. Second role is Value, who run the asset allocation and take a long-term view about where markets are heading. And then the third layer, of course, is Columbia Threadneedle, who are the investment manager of the product and implement the overall strategy, which is set by Value. In terms of the Horizon funds themselves, they are obviously UK NERS. They are fund-of-fund structured, and the three partners work together to get the most effective return for our clients. Why have we chosen to extend the partnership, which was already the case on the Zurich, and as we took on the business in May this year with Value and with Threadneedle? We really like the approach of Value in terms of how they run the asset allocation. They have an excellent track record, and I think one of the key things I look at is how they evolve the portfolio over time. So they are not setting an asset allocation once every 3 years. They're dynamically looking at how assets are valued on a very long-term basis. They're doing it in a quantitative way, and typically they will not change the portfolio very much. But when there is a major issue, they will react, and they will do that quite quickly. And I think that's a major plus for our clients and our investors. And I can take the example earlier this year where they decided they were no longer positive on UK property and on UK equities, and we both reduced those asset classes. So it's a dynamic way of managing the portfolio, and I'm sure Salman will tell us more in a minute.
Okay, when you say it's a fund of funds, is Alex permitted only to choose Threadneedle or Columbia Threadneedle funds, or can he choose funds from across the market?
So the approach we have with the CTI is that they invest in Threadneedle funds only. But obviously there are big advantages to this approach. One, and Alex will maybe tell us more later, but we really like the way CTI organize and structure the portfolio, how they implement the views of Value. We think that they have a good mix of different styles, and they're able to mix some markets and styles which are somewhat more growth and others which are value. They can mix and match different managers, even if it just comes from within the CTI group. And they generally have a very good track record and have very good risk control because they know exactly what's happening in each single fund. And then lastly, something which is very important for us as ACD is that because we've been able to outsource in bulk in a significant amount, because Horizon funds today are just under £700 million, it does mean we can have a competitive arrangement with them in terms of fees. And therefore, and by the way, fees are a very important driver for returns. So therefore, we are able to offer Horizon as an actively managed fund at a reasonably competitive level, I believe, in terms of investment fees.
Okay.
Perhaps Alex would like to jump in on that and just add something around the overall approach.
Yes, I entirely agree with what you say. Obviously we do invest just in in-house CTI Columbia Threadneedle funds, and to me as fund manager, that does have enormous advantages. I mean, you've mentioned keeping costs down. You've mentioned it enables better risk analysis. We can really drill down into everything we hold in the funds. But also, as overall fund manager, it's so important to know exactly what is going on in the funds, what the US desk are investing in, what sort of approach the UK team are looking at when you're picking those funds. So I know more about what's going on. And the other thing, which is very important, is the governance of the sub-funds. ESG is more and more on people's horizon these days, and I know all the funds we're investing in have been thoroughly screened, analysed, and the investment process is looking at ESG, social investing thoroughly, responsible investing, and that is very important. I think from a performance point of view, those sort of companies that are good on that front tend to perform well, and from a client's point of view, knowing that the funds they're investing in have ticked the ESG box.
Okay, well, we'll explore that in a little bit more depth later on, but thanks for that, Alex. And before I come on to Salman, just one more question from you, Thomas. Why is the role of the ACD so important, and what does it mean for investors and advisors?
We feel at Embark that the role of the ACD, it has two parts. Firstly, obviously, we have a team of people actively checking and controlling that the product, the funds, are doing what is defined in the prospectus, that, for example, we are adequately and well diversified, that we're within the investment limits, that we're investing in liquid assets, that the client cash flows in and out of the funds which go to Northern Trust, our custodian depository, are completely safeguarded in terms of cash rules. So there's a very strong oversight role which we have as the ACD, and we are fully dedicated to the Horizon funds. But I would also say that our slightly different approach, Richard, would be that we see ourselves as a somewhat active ACD. So that means that we're not just people who are strong on the operational side, but we have a number of people in our team who understand the investment process and understand what our outsourced partners, eValue and Columbia Threadneedle, are doing on the investment side. And it is not for us as an ACD to tell them how to take investment decisions on a daily basis. That we delegated to them. But what we are looking at is what is the mandate we've given them, and how do we work with them to make sure that they have the right mandate to generate the best returns for our clients. And to just give you one example, recently we've had a discussion with Columbia Threadneedle around high yield. High yield traditionally was not necessarily included in the Horizon funds, but we felt that it could be an opportunity to better diversify the portfolio. So we have had that discussion. It was a very detailed discussion also around what type of guidelines then there should be for high yield, because obviously we would need to only put in a small amount of that, and we'd have to have clear risk limits and controls. And we've now agreed with Columbia Threadneedle that that might be added in as a diversified asset. Now, I know that Alex hasn't added that in as of yet, but he has that now in his armory to add to returns when he thinks it's the right moment. And so, just to go back to your question, how do we see our role as an ACD? Obviously, we are very much engaged with our partners to make sure the product sticks within rules, regulations, and everything around client money is completely taken care of, and there's complete oversight of our partners. But we also are not shy of engaging with eValue and CTI about long-term investment issues and working with them to make sure the portfolio has the right degree of diversification, and that all the opportunities they might wish to have are there within reasonable constraints and guidelines.
Okay, and critically, for what that also means for investors and advisors is ultimately your role is to ensure the objectives of the funds are delivered, and that if, yes, heaven forbid, if eValue or Columbia Threadneedle weren't doing or delivering what you require, you could change that if necessary.
Yes, we very much believe in building long-term partnerships, and we have reiterated our commitments to continue to work with eValue and Columbia Threadneedle after the the changeover from Zurich to Embark for the Horizon funds. But Richard, you are right. It is our job to make sure that they do their job adequately, and not at all for discussion today, but we do have to make sure that they're the right partner for us in the future.
Of course they are. What can I say? Anyway, so Salman, thank you, Thomas. I'd like to move on to you. So just for the benefit of the audience, as I understand it, the objectives of the funds are to deliver capital growth within certain risk parameters, and there's an increasing or there's a range of risk parameters. Can you talk initially about how you think about risk and how you measure the risk side of things, and then how you go about asset allocation? And then in doing that, what asset classes do you include and what don't you include, and why?
Thank you, Richard. So everything that we do is based on an asset model that we have spent a lot of time working hard on, so that whenever market changes, we don't have to do much. It depends on a data-driven methodology. All that needs to go into it is what the market is saying in aggregate, and it comes up with forecasts of what the model thinks is going to happen with returns. And then what those things do is drive the asset allocations that we then pass on via Embark to CTI to get implemented. All of this sits on a risk basis. The way we do risk is we divide the risk band between cash at the low end and something like UK equity at the high end. Embark and previously Zurich were working on a risk scale of 5. That means the banding had to be divided into 5. The way we divide risk banding is to move from smaller risk levels to higher risk levels in a proportionately greater amount. And what that tends to do is position the risk bands in such a way that the lower risk levels are closer together, and as you move up the risk scale, the upper risk levels get further and further apart. And the rationale behind that is that low risk investors are more sensitive to changes in risk, so their bands are rather tight. And then as you move up the risk scale, get more risk averse, then there is more freedom to move around in the risk scale, which again is in line with what we expect from a high risk investor. So that's why the banding is spread in that way.
Sorry to interrupt. How are you measuring or defining risk in that process?
Indeed. So I was just going to come to that. So what we're doing in defining the risk band is looking at the uncertainty around the expected growth rate. So one of the key things that our model does is take term into account. So if you've come to us and said, oh, I've got a long-term investment horizon, we would ask you what your investment term is like, because the model that we have is very accurate when it comes to defining the term structure of investment. So once you've given us what the term structure is, and in the case of Embark, it's a long-term horizon, what we do is then have a look at what portfolios or what strategy would be the best to achieve the objectives of the fund, which in this case is capital growth, and the dispersion or the uncertainty around the expected growth rate defines what we call risk. So we've got like these 10 or 12 asset classes to deal with, and these are very broad asset classes. So when we look at the market, what our process is actually doing is interpreting the market expectations, taking into account the structure of the returns, and then the level of everything that we can see. So what we're doing is we are working out what the market thinks the situation is and what would be the best way forward. And then we form a balanced view based on market, aggregating the market knowledge. And what that means is it gives us the ability to have something like a strategic asset allocation, but what we like to describe as a dynamic strategic asset allocation, so a dynamic SAA. And because we're not going very deep into the asset classes as such, we have a very broad asset class view that leaves ample scope for directional or sectoral views, and that's where CTI come in and add their extras, if you like, strategies that are more market beating, or if they've got a view on something that is advantageous in the short term, they can add those views on top. But what we're providing is something that might be thought of as an SAA, but I'll hasten to add that we don't think of SAA as a static asset allocation that is changed every 3 years or 5 years, because the SAA is the best available asset allocation, taking a long-term focus into mind. And as the market situation changes and evolves, it should change. So in order to provide the best long-term look, the strategic asset allocation also has to change. And that's why we are very keen in calling it a dynamic strategic asset allocation.
Okay, so that's really helpful. A couple of questions on the back of that, and then I'll come to you, Alex. Firstly, it is, do you include property as one of the, or commercial property as one of the asset classes, and any kind of alternatives, whether it's infrastructure, private equity, absolute return funds? And then secondly, you talk about moving the asset allocation depending on what's going on in the market. Would I be right in assuming in a year such as 2020, when there's been great volatility in markets, you've moved the asset allocation around more?
Yes, so I'll start off with the comment about property. I mean, we do allow for property normally in our asset allocations, but having looked at what the market has been doing recently, the outlook isn't very good. Property funds have been locked out a lot, so liquidity is also not very good. And property funds which are investing in direct property also tend to have high costs. There are entry and exit fees. There's a lot of bid-ask spread. So from that point of view, and taking into account what the outlook for properties at the moment, it's probably not a very bad time to not have it in the portfolios, and that's what the current situation is. I mean, in some ways it is unfortunate, because property has had some very good characteristics, and that's why it has been in the fund. I mean, it's got low short-term volatility, but equity-like potential in the long term, and is also not very much correlated with the markets, with the equity market in particular. So it has like a few advantages, but lately these advantages seem to be outdone by some of the difficulties that property funds have in providing an asset class that would be especially good for retail investors, for example. So if there are liquidity promises to be made, then locked out funds are not possibly the best way forward, and that's why we're not having them in the portfolios at the moment. So I think that would serve as the basis for why we're not including property currently, despite the other advantages I've mentioned already. Could you just remind me what the second question was?
Yeah, sure. So associated with that was, do you put any other types of alternative investments in there? So, for example, infrastructure or private equity or absolute return funds or what have you, or do you try and keep it relatively simple?
We do keep it relatively simple. I mean, the Embark portfolios have actually evolved from something that is retail oriented, and retail oriented portfolios generally tend to be safe or safer. For the high risk investor, of course, there are more exotic things to go into, but in general, they are relatively safe. We do steer away from things like private equity because it's very difficult to see what's happening inside the funds or funds of that nature, and the same goes for absolute return strategy funds. We can include them if we have those asset classes, but traditionally we've not included them because at least retail-oriented portfolios have not made much use of them, and most of our thinking that comes behind that is because they do a lot of things and there's lots of different things. So having a broad asset class to define what particular funds do is maybe a little bit beyond the scope or the remit of the definitions that we use for coming up with the asset allocations. So I mean, that's one reason you would say. The other reason is from a theoretical point of view, you may argue that having more and more assets means that you're pushing the efficient frontier upwards and to the right, if you like. So what that would that generally from theory would mean that you're getting more bang for buck. But on the flip side of things is the more assets you have, the more turnover you're likely to have, the more moving parts you have, the more transaction costs you will have, and eventually the returns are diminishing as you add more and more asset classes. So what we believe at the moment is we've got a good asset mix. It's got a good mix of what fixed the retail investor. It also has a good mix of the equity exposures that a retail investor would be interested in. And we come up with a way of finding the strategy that gives the best range of outcomes for someone who's investing with that investment objective in mind and subject to their risk aversion or risk constraint that they have. So we can advise on that.
Okay, one very quick last question, because Alex has been waiting very patiently in the wings there. Just in a year such as 2020, when there's been much greater market volatility, does that necessarily mean then the asset allocation changes more?
The asset allocation, in some ways, you could say that it does not, in that almost everything across the board has been affected to some extent. If you're thinking of maybe bonds versus equities, for example, so has the balance between bonds and equities shifted? In some ways it hasn't, and the reason for that is there are not many other alternatives that have done better. I mean, commodities, for example, have seen oil prices go even negative at some earlier part of the year. So our approach is basically to get the best expected outcomes of the current situation, and because there's been across the board not a lot of difference between how different asset classes have reacted, and most of the pressure has been downward. So in that respect, no, not a lot of change. But we could also say from the other side that if we're being very particular, then we have seen that the UK market, the UK equity market, has underperformed, and there's definitely a decline in outlook. So from that point of view, yes, there is some difference. What we have also seen is that investment has gone international. So it has a more internationalist view. So overseas equities are almost as easily accessible as UK equities. So a lot of investors have that under their belt as well. So that's another reason why we might think that UK equities may be less favorable, at least in the short to medium term. And we see that in the model.
Perfect. Okay, thank you, Alex. You've been extremely patient. I'll bring you in at this stage.
I've enjoyed listening to my colleagues on the Horizon team speaking.
Hopefully it all rings very familiar. So where are the portfolios? How are they positioned at the moment, Alex? And what are you excited about in markets and the interpretation that you're allowed? And what are you wary of?
Oh God, there's a lot in there, Richard. How are the portfolios currently positioned? I mean, we take an optimistic view of equities at the moment. They've clearly had a fantastic rally from the depths of the bear market in the spring, but we think equities still offer good value. And I mean, the reasons largely for that is that the authorities have taken rapid and massive action to get things going again, both fiscally by government expenditure and central banks. They pushed interest to effectively zero, and now we have the Bank of England talking about negative interest rates being charged to leave money at the bank, and huge quantitative easing programs buying up government bonds to drive the yields down. So I mean, these are big moves, and we think that will get economies moving again. We've had good results from companies, better than feared. Clearly, a lot of companies are suffering badly, but recent reporting, and we're well into the third quarter reporting season now, has come in better than expected. And the other thing to remember is there's a lot of companies suffering really badly in the environment, but there's lots of companies that are having a very good time at the moment, that are well positioned for the trends taking place in markets, things like online retail and so on. So there's good parts of the market. We think that we're in the early stage of an economic recovery and equity market cycle. So we take an optimistic view of equities from here. They're more expensive than they were, but not too expensive. So we are above Salman's strategic benchmarks in equities. Bonds, on the other hand, we're a bit more cautious of. We think it's a good environment for government bonds, gilts in the UK, low inflation, low interest rates, uncertainty, and so on, are normally good times for government bonds. It's just the fact that the yields are so low, we just don't see much value in them. But in bonds, there are more attractive areas, and both Thomas and Salman have talked about high yield. We think that corporate debt, corporate bonds, whether it's the high yield ones or the investment grade ones, still offer pretty good value relative to government. So that's the bias we've got in the portfolios on the bond side at the moment.
Just on the equity side, so Salman said they were pretty gloomy about the UK. Do you concur with that? So is your extra exposure overseas, and if so, where? And on the bond side of things, there again, are you favouring investment grade, or and are you favouring overseas bonds or UK bonds?
Yeah, on equities, the UK, we do concur with Salman on that one. We think the UK, on a sort of medium-term view, is not in a good place relative to other markets. And I mean, the reasons for that are, firstly, we haven't handled COVID well, if we're honest. We're behind the curve on that, behind where a lot of other countries are. We are unique in having this Brexit risk. Europe's got it to some extent, without doubt, but the UK is most exposed to Brexit. So that's another risk. And the third factor is that just the makeup of the UK market to us isn't particularly attractive. And if you look at the UK market, there's a lot of oil companies, there's a lot of mining companies, there's a lot of banks. And those just aren't the sort of sectors we think are attractive in today's world, today's changing world. So we see much better opportunities overseas. I mean, particularly, you know, I mentioned that companies that are backing the right trends are having a good time. And I really do think that's an important aspect of investment at the moment, that there were these important trends taking place in consumer expenditure, in business activity, and COVID has just accelerated those trends enormously. So the shift to online retail has accelerated, the shift to online social activities accelerated, the shift to cloud computing's accelerated, the cashless payments accelerated, streaming's accelerated, online conferences has accelerated. And so it's important to back the companies that have good exposure to that and expose yourself to the markets that do. And the really dominant players in all those trends you find in the US, and hence we really like the US at the moment. It's one of our favoured markets for that reason. And the other area we see great growth potential is the Far East, particularly China. Partly they've come through COVID in very good shape. And you know, we're expecting the economy to grow this year, the only major economy to see growth. But there are some companies over there with real growth potential, partly in the IT world, but also making the most of the growth of consumer expenditure, consumer wealth in China. So businesses exposed to education, to travel, to insurance are great opportunities. And we just don't find as many of those growth opportunities in the UK. So I agree, we think there's better opportunities overseas. And secondly, you asked about bonds, where our bias is. Yeah, we do think that corporate debt is more attractive than government debt. And there's two reasons for that. With corporate debt, you get paid a premium, a spread, as we call it, which is an extra yield per annum for taking on board the extra risk of backing companies rather than governments. And that spread or incremental yield at the moment is pretty attractive. It's come down as markets have rallied, but it's still above average levels. So you're getting paid for taking that extra risk. But secondly, I mentioned big QE, quantitative easing programs by central banks, and as well as buying government bonds, they are buying corporate debt. So you've got extra support there from central banks.
Okay, that's really clear. I'm interested, you talked about obviously having significant exposure to the US. There's a train of thought, I'm not necessarily I agree with it, but there's a train of thought that suggests that some of the market's been quite narrowly led in the US by some of the big FANG businesses, let's call it. And should people be concerned about the valuations in those businesses? Do you think the recovery in America or the opportunities in America is broader than that, or not?
I mean, there are lots of opportunities in America, but I do think that those big companies, the FANGs, as you mentioned, are still very attractive. I mean, they are expensive relative to other sectors, other companies, but so are the opportunities large. I mean, you're talking about really dominant global players, and it's going to be very hard for other people to really compete with them now. When it comes to online retail in the West, Amazon just are up there leading the way. When it comes to cloud computing, it's Microsoft, it's Amazon that are leading the way. When it comes to search, you can't really beat Google. And these are really growing markets, and they have got a fantastic position. They are, I mean, the P's are quite high, but it's not like the tech boom of the late 1990s. These companies are making big profits, and very differently from them, they are generating huge amounts of cash, which they're reinvesting in new areas for growth in the future. So, they've had a phenomenal run, and they may well go through a bit of a correction. We may well see a short-term rally in value, but I do think over the medium term, these companies remain very attractive.
Okay, Salman, can I bring you in?
Yes, I just wanted to just give a bit of perspective from the models side of things, because we look at it from a very broad or a high level, if you like, more neutral perspective. And I obviously have said that the UK's prospects are not as good as some of the other equities. But the point that I'd like to make here is that about how we think about equities in terms of whether they're overvalued or not. I mean, the prospects are not very good, but they're still good enough to justify their allocation in the portfolios. And one of the main reasons we can justify that is because they offer a good outlook for growth. So at times of quantitative easing, as we've seen, what's happening is like the big central banks are buying the debt that's out there, and that's leaving investors with cash in their hands. And some of that cash is getting invested in equities. So even if prospects do not look super brilliant all the time, there is cash to be invested, and that is being invested. And for those who are not investing in equities, are going for corporate bonds. And those who had corporate bonds are probably using that cash to go into high yield bonds. So the point here basically is that an economic downturn is not necessarily something that is worse or deters investors from investing. Yields are very low at the moment, and with yields being very low, people who are trying to save for the future, save for future expenditures, have to put their money in something that is has more potential for growth, and again they go towards equities. So I think the basic point here is that yes, we see prospects not being very good, and the UK relatively lagging behind the US, for example, in prospects, but equities are still a very important part of the portfolio, and we see that going forward. They have good growth potential, and that's very attractive to any investor.
Okay, great. Thank you. Alex, what do you perceive to be the biggest risk in markets at the moment? What are you worried about? Is it perhaps with all this quantitative easing, the spectre of inflation? Is it economies not growing? Is it something that I'm not talking about?
Well, there's lots of risks, but there always are lots of risks in markets. And, you mentioned some of them there. There is a risk of inflation, but we don't think that we're in an inflationary environment. I mean, certainly in a lot of circumstances, what central banks and governments are doing, huge fiscal expenditure, huge monetary easing, that could lead to inflation. But in the current environment, where there's just so much spare capacity, we don't see it leading to inflation. As long as further down the line, when we do see the recovery, then they rein back in again, and we think they will. So we think inflation will remain low. What other risks are there? I mean, clearly, we're almost through the US election, but we don't quite know what the outcome means. We think we know, but we're not dead certain. There are risks there. Certainly, China-US trade talks is a risk. Certainly, Brexit is a risk. I personally think that they will cobble together some sort of a deal. But there's lots of things. But to be perfectly honest, we do think that the optimistic outlook that I mentioned earlier on about equities, and I entirely agree with what Salman said, will outweigh these problems. And you can always worry about things in markets, but you look back through history and markets get through them. And as long as there's always going to be volatility, but as long as you're taking a medium to long-term view of equities and ride out the difficult volatile patches, which will come along, we think that the medium to long-term outlook for equities remains good, and a sound place for investors' savings.
Okay, great. That's a lovely upbeat note to almost. Thomas, can I bring you back in at the now? We touched on this briefly earlier. There's a far greater focus on as an input ESG integration in terms of how investment managers are taking into account environment, social and governance issues in the pricing of securities. And also an increased, off quite a low base, interest in responsible investing. So trying to do good with your investments, avoid harm or lead change alongside the financial returns and the risk side of things. Where are you, or where is Embark in its thinking about how, or if and how, this becomes more relevant for investors, and might we see something become more embedded in the Horizon multi-asset portfolios to this extent?
Richard, so thanks for the question around ESG. A few points I would make around that. Firstly, we see the Horizon funds as a package, a solution for financial advisors to use for their retail clients, which does evolve with the times. And we've had some internal discussion whether we should have like a separate ESG range next to Horizon. And my view, running as CEO of the business, is that I would prefer to evolve Horizon over time to meet the needs of the clients, to support financial advisors in their conversations with clients in this year and in 21, rather than creating lots of different products. And so in terms of your question around ESG, we recognize that ESG is important, especially I would say the E and the G, that we think that our fund managers engage with the companies they're invested in and look what the impact is of environmental factors on the investment returns of the companies and how things are evolving. And likewise, governance is very important, because well-governed companies act more in the interest of shareholders and can probably generate better returns. So what we did from the 1st of May onwards, what Embark has done, is to set up an ESG statement on our website and to actively engage with Columbia Threadneedle in terms of how ESG is taken into account. Now, just to be very clear, we have not said we're going to massively exclude companies for ESG reasons, because we do not believe that that is the right thing to do for the retail clients. We're more taking ESG into account in our investment decisions, and we are trying to make the right investments, get the right returns for our clients, but also think about how environmental and other factors can impact returns, and making sure we're in the right investments. Maybe Alex would just like to pick up on that briefly to explain how this overall approach, which we have set for the Horizon funds, is actually implemented by Columbia.
Yes, I mean, we think ESG analysis is absolutely critical. And it really is an embedded part of our investment process, an embedded part of our research process on all the desks, and the individual equity desks or bond desks are supported by a separate ESG team we have. As you said, Thomas, I mean, companies that score well on ESG are basically well-run companies, and they're the sorts of companies you want to back, well-run companies doing the right sorts of things. So we think it's good from an investment return point of view, backing good companies from an ESG basis. And on your point, we're not trying to exclude things. And again, yes, we firmly believe it's better not to exclude particular sectors, but within sectors that might have question marks around them, to pick the companies that are doing the right things and moving in the right direction. We're all going to carry on using oil, burning oil for the foreseeable future, but within the oil sector, we want to pick the companies that are shifting at a good direction, that are really investing in renewables, that when they extract oil, which they're going to have to do, they do it in as environmentally friendly, clean a way as they possibly can. And we think that's the way forward.
Brilliant. Okay, gentlemen, I'm acutely aware of time, so I think we're going to wrap up the discussion now. Thank you very much indeed for explaining how the portfolios are run, how you work with each other, for giving your views on where we are at the moment, and for putting broadly optimistic view about the future. What we're going to do now is open the floor up for questions, and we will respond accordingly. But thank you very much at this stage for your contribution thus far.
Thank you.
Thanks.
Thank you.